Hi, and thank you for joining us for the third quarter market review and outlook. My name is Jason Gunkel, and I lead our investment team here at Severson Strege. As football fans in the U.S. celebrated the kickoff to the season, investors also celebrated the kickoff to the Fed cutting interest rates in September. After a volatile August, the stock market rallied and is up 5% for the third quarter and 21% year to date. With the drop in interest rates, the highly anticipated rally in the bond market has appeared to begin. The U.S. aggregate bond index is up nearly 5.5% for the quarter, turning the bond returns positive for the year, up close to 5%. We are recording this about a week before the end of the quarter, so these returns could change a bit. The Federal Reserve has a tough balancing act of trying to combat inflation and a recession at the same time. While inflation has remained in check, even though it is above the Fed's long-term target of 2%, a slowdown in job growth was the key factor in the Fed's decision to make a larger than expected rate cut of 50 basis points rather than the typical 25 basis points. This dot plot, which reflects where various members of the Federal Reserve expect the federal funds rate to go during the next few years, shows more rate cuts are likely, both this year and over the next 2 years. It shows another 50 basis points in cuts are expected by the end of this year, and another 100 basis points by the end of next year, and then more in 2026. If the economy can avoid a recession, the anticipated prolonged interest rate cuts could be good news for both stocks and bonds. Since 1966, the U.S. stock market has returned 18.5%, and the bond market has returned nearly 10% in the 12 months following the first interest rate cut when no recession occurs, according to Morningstar. With interest rates starting to drop, bond prices have finally started to rise following their longest bear market in history that began in July of 2020. Since 2023, money market funds have seen over $1 trillion of inflows, according to Morningstar, as a safe place to park cash and earn good interest. But now investors might be wise to start moving this money into bond funds that are offering attractive yields and could likely see price appreciation as interest rates continue to drop. The stock market is off to its third best start ever in a presidential election year. In the fourth quarter, investors will likely turn their attention towards the election, and market volatility could pick up. We will have more commentary on the election's potential impact on the markets and economy in October. But it is important to remember that many factors affect the financial markets other than who is in the White House. Democratic and Republican presidents have similar records of market performance while in office. It is much more important that investors stay invested and not try to time the markets. Since 1953, if you invested $1,000 in the market during only the years that a Democratic or Republican president was in office, you would have either $50,000 or $31,000 respectively today. But if you stayed invested that entire time, you would have over $1.58 million. So, while the nerves of investors could be challenged as the election approaches and market volatility could increase, there are reasons to believe that this market rally will continue. We encourage you to stick with your long-term investment plan to reach your goals. We thank you for your continued trust in us, and we will continue to look out for your best interest. Take care, and we'll see you next quarter.